August 1st, 2012, 9:30 a.m. The opening bell rings on Wall Street. Within seconds, trading screens across America start flashing warnings. Something is very, very wrong. At Knight Capital Group's headquarters in Jersey City, programmers stare at their monitors in horror. Their trading system is sending out orders, millions of them, orders they never authorized. In 45 minutes, Knight Capital will execute 4 million trades, buy and sell the same stocks over and over at lightning speed. Stock prices go insane. Companies worth billions see their share prices jump 10%, 15%, 20% for no reason. By 10:15 a.m., Knight Capital will have lost $440 million. The company will be bankrupt, and nobody can figure out how to make it stop. This is the story of the 45 minutes that destroyed Knight Capital, and how a single line of old code brought down a billion-dollar company.
Knight Capital Group wasn't some startup. They were one of the biggest players on Wall Street. Founded in 1995, they specialized in market making. Essentially, they were the middleman for millions of stock trades every day. If you bought stock through E-Trade or TD Ameritrade, there's a good chance Knight Capital executed your trade behind the scenes. They handled roughly 10% of all U.S. stock trading volume, billions of dollars every single day. By 2012, Knight Capital had over 1,400 employees and a market value exceeding $1 billion. Their competitive advantage? Speed. They had invested millions in high-frequency trading systems that could execute trades in milliseconds. These systems were complex. Millions of lines of code, trading algorithms, automated strategies running 24/7. And buried somewhere in that code was a disaster waiting to happen. In July 2012, the New York Stock Exchange announced a new retail liquidity program. Knight Capital needed to update their trading software to participate. It seemed like a routine change. The development team wrote new code. They called it the Retail Liquidity Program Module, or RLP. But here's where things went wrong. The new RLP code reused an old flag in the system called PowerPeg. PowerPeg was an old algorithm Knight had stopped using years ago. It was supposed to be dead code, dormant and harmless. The developers assumed all references to PowerPeg had been removed from their production systems. They were wrong. On July 27th, Knight's IT team began deploying the new RLP software across their 8 production servers. They successfully updated 7 servers, but for reasons that remain unclear, they failed to update the 8th server. That 8th server still had the old PowerPeg code, active, running, waiting. Knight's testing procedures failed to catch this. Their quality control failed. Their deployment checklist failed. On the evening of July 31st, Knight Capital went home confident their new system was ready. Tomorrow morning, they'd find out just how wrong they were. August 1st, 2012, 9:29:58 a.m., 2 seconds before the market opens. Knight Capital's new RLP system activates automatically. All 8 servers come online. 9:30 a.m., the market opens. Orders start flowing through Knight's system. 7 servers execute the new RLP code correctly. They process orders normally, exactly as designed. But the 8th server receives the RLP trigger and misinterprets it. It thinks it's being told to activate PowerPeg. PowerPeg wasn't designed for 2012's high-speed markets. It was ancient, aggressive, and completely inappropriate. Within seconds, Server 8 starts executing PowerPeg trades, buying stocks, then immediately selling them, over and over and over. 9:30:15 a.m. 15 seconds into trading, Knight's risk management systems detect abnormal activity. But the alerts are confusing. Nobody understands what's happening or which system is malfunctioning. 9:31 a.m. Server 8 has now executed thousands of trades. Knight is simultaneously buying and selling the same stocks. They're buying high and selling low, the worst possible strategy, losing money on every single trade.
9:35 a.m. The problem is getting worse. Server 8 is now handling multiple stocks. Retail giants like Walmart, Best Buy, Ford. These stocks start moving erratically. Walmart jumps 2%. Ford drops 3%. Prices are swinging for no fundamental reason. Other trading firms notice. What the hell is Knight doing? They start exploiting Knight's obvious errors. High-frequency traders begin front-running Knight's orders. They buy just before Knight buys, then sell to Knight at inflated prices. 9:45 a.m. 15 minutes into trading. Knight has lost over $200 million, and they still haven't stopped the system. The IT team is frantically trying to isolate the problem. Which server? Which algorithm? How do we shut it down? 9:50 a.m. 20 minutes in. Someone finally identifies server 8 as the culprit. But they can't just pull the plug. Knight Capital is still processing legitimate orders for their clients. If they shut down completely, they'll fail to execute millions of dollars in customer trades. They could be sued, lose their license. They decide to disable server 8 and reroute legitimate traffic to the other 7 servers. 10 a.m., 30 minutes into the disaster. They finally kill server 8's connection, but the damage is done. Knight Capital has accumulated massive positions in 154 different stocks. They own millions of shares they don't want, shares they bought at inflated prices and need to sell immediately. 10:15 a.m. The final tally comes in. In 45 minutes, Knight executed approximately 4 million trades. The total loss? $440 million. Nearly $500 million. Gone in less than an hour. Knight Capital's entire net worth was around $365 million. They had just lost more money than the company was worth. By lunchtime, Knight Capital's stock price was in freefall. Investors knew the company was finished. Knight's executives spent the rest of the day on the phone, desperately calling other financial firms, begging for a bailout. That weekend, a consortium of financial firms agreed to inject $400 million into Knight Capital to keep them alive. But there was a price. The bailout gave these firms 73% ownership of Knight Capital. Existing shareholders saw their investments wiped out. A stock worth $10 before the glitch was now worth $1.50. CEO Thomas Joyce went on CNBC to explain what happened. He looked shell-shocked. "We had a major technology issue," he said. That was an understatement. The SEC launched an investigation. How did this happen? Who was responsible? Why weren't there safeguards? They discovered the deployment failure. The untested 8th server, the reused flag, the inadequate quality control. In 2013, the SEC fined Knight Capital $12 million for failing to have adequate risk controls. The company accepted the fine without admitting wrongdoing. By 2013, Knight Capital no longer existed as an independent company. They merged with GetCo, another trading firm, becoming KCG Holdings. In 2017, KCG itself was acquired by Virtu Financial. The Knight Capital name disappeared entirely. The 1,400 employees who worked at Knight Capital scattered. Many lost their jobs, some lost their retirement savings. The Knight Capital disaster exposed a terrifying truth about modern markets. A single line of code, one misconfigured server, 45 minutes, and $1 billion company was gone. This wasn't a hack, it wasn't fraud, it wasn't sabotage, it was a software deployment mistake. The kind of mistake that happens at tech companies every day. But at Knight Capital, it meant financial annihilation. Today, trading firms have better safeguards, kill switches, position limits, automated circuit breakers, but the fundamental risk remains. Financial markets run on code. Millions of lines written by humans who make mistakes. High-frequency trading happens in microseconds. Too fast for humans to monitor, too fast to stop when something goes wrong. We trust these systems with trillions of dollars, and we pray the people writing the code don't make mistakes.
Because as Knight Capital proved, one mistake can destroy everything in minutes. The scariest part? Knight Capital was one of the most sophisticated trading firms in the world. If it could happen to them, it could happen to anyone. 45 minutes, $440 million, one company destroyed. If you found this story as terrifying as I did, subscribe for more. Until next time.